Picture the scene. The room is silent. The only light comes from the cold glow of a monitor reflecting off the face of a trader watching charts move up and down. Candles flicker like they're alive, pulsing with every tick. His heartbeat races, not because the market is doing anything special, but because inside his mind a silent war is raging. This is the part nobody talks about. Most people think trading consistency depends on finding the perfect strategy, the magic indicator, or the mentor who holds a hidden secret. But the truth is that behind every single click lies a psychological battle that determines whether this trader survives or becomes just another casualty in the statistics of failure. Consistency. It sounds simple, but it is the true holy grail of trading. Every trader wants it, every trader chases it, but almost no one ever finds it. Why? Not because of a lack of technical knowledge, not because of missing tools or software, and definitely not because the market is rigged against them, as so many like to believe. The real answer is far harsher. Consistency isn't a market problem, it's a human problem. Traders think they need to control the charts, when in reality, they need to control themselves. Think about how most people begin their journey. Their first contact with trading usually comes packaged with promises, financial freedom, the dream of living with just a laptop and Wi-Fi, the power to multiply money in days instead of years. It's seductive. So the beginner dives headfirst into learning. Hours of YouTube videos, online courses, books on technical analysis. They memorize support and resistance, moving averages, candlestick patterns, news events. It all feels like the missing key to unlock endless profits, and in the beginning, sometimes it works. A string of winning trades gives the illusion that the path has been found. Confidence explodes. The ego swells. The trader feels unstoppable, as if they are about to escape ordinary life. But this is when the trap closes. Because right after those first wins comes the inevitable losing streak. And when it hits, the entire tower of confidence collapses. Doubt creeps in, fear rises, strategies are abandoned, new ones are chased. This dance of hope and disappointment repeats so many times that most traders end in the same place, with an empty account and a broken dream. But here's the truth. The market never promised consistency. It wasn't designed to deliver stable, predictable wins. The market is unstable by nature, chaotic, volatile, shaped by everything from central banks to random tweets. Expecting stability from the market is like expecting the ocean to never have waves. Real consistency doesn't come from the charts. It comes from the way the trader responds to them, and this is where most traders go wrong. They cling to the illusion, if I just find the perfect system, I'll never lose again. But that's a dangerous fantasy. Any trader can hold the most profitable system in the world and still fail miserably. Why? Because the enemy isn't the setup, it's the trader's own mind. Without discipline, even the best strategy is worthless. On the other hand, a trader with a simple, basic method can reach incredible results if they have the strength to stick to it. The root of the problem is this. The human brain isn't wired for trading. We're wired for survival. In front of risk, our instinct is fight or flight. That wiring kept our ancestors alive, but in the financial markets, it's a disaster. Fear makes us close trades too early, cutting profits short. Greed pushes us to risk too much, chasing bigger wins. Impatience forces us into trades that don't fit our rules, just to feel like we're doing something. And overconfidence, built after a string of wins, convinces us that rules don't matter anymore, until one bad decision wipes out weeks of progress. Picture this. A trader wins 3 trades in a row. The account grows, ego skyrockets. He thinks, this time I've cracked it. I can't lose. So he doubles his position size, ignores risk management, and dives in. The market, indifferent to human emotion, does what it always does, moves freely. In minutes, all those hard-earned profits are gone. The devastation is crushing. And this isn't a rare story, it happens every single day. Now imagine the opposite. Another trader loses 3 trades in a row. Fear and frustration take over. He can't accept being wrong, so he breaks his own rules. increasing his lot size, trying to win it all back in one trade. But the market doesn't care about his feelings. Instead of recovering, he blows a large part of his account. The tragedy wasn't the losing streak, it was his inability to control himself in the face of it. That's the truth. Consistency isn't about predicting the market. It's about predicting yourself. It's about creating a process strong enough to withstand emotional storms. Think like a casino. A casino doesn't know which spin of the roulette will be red or black. It doesn't know which gambler will win tonight. But it doesn't matter, because the casino understands probability. Over thousands of spins, the house edge guarantees profit. That's how traders must think. You don't need to win every day. You don't need to win every trade. You only need a small edge and the discipline to repeat it relentlessly without letting fear or greed interfere. But here's the paradox. Every trader knows this in theory, yet almost none can apply it in practice. Why? Because theory doesn't prepare you for emotion. Reading about discipline doesn't make you disciplined. Knowing risk management is important doesn't stop you from breaking it when adrenaline kicks in. The only way to build consistency is to train your mind like a muscle through repetition until discipline becomes second nature. It's boring, it's unglamorous, and that's why almost no one achieves it, and that's the first great lesson. If trading always feels exciting, you're probably doing it wrong. Real consistency is calm, it's structured, it's predictable, not in terms of market outcomes, but in terms of your own behavior. That calmness doesn't come from the market, it comes from you. Fear, greed, impatience, overconfidence. These four emotions are the silent assassins of trading consistency. They lurk in the background of every decision, whispering in your ear, tempting you to abandon discipline. And the cruel part is this: most traders don't even realize these forces are controlling them until it's too late. Let's start with fear. Fear is the most common enemy because it hides in so many forms. It's the fear of losing money, the fear of being wrong, the fear of missing out on a move. You spot a perfect setup. Your strategy says, take the trade. But then the voice of fear speaks. What if it fails? What if you lose again? What if this is the start of another losing streak? And so you hesitate. You watch the trade take off without you. Or worse, you enter. But fear makes you cut the trade too early, grabbing a tiny profit while your original target plays out perfectly without you. Fear doesn't care about your system. It only cares about protecting you from uncertainty. But in the markets, uncertainty is the game. And when fear dictates your actions, consistency becomes impossible. Now meet fear's twin brother, greed. If fear makes you exit too early, greed makes you hold too long. You set a profit target, the market reaches it, but instead of following the plan, you think, what if it keeps going? I could double my win. And so you hold. Sometimes you're rewarded. But more often the market reverses and you watch helplessly as your profit vanishes. The pain of seeing a winning trade turn into a loss is brutal, and yet traders repeat this mistake again and again because greed convinces them that following the plan is never enough. Greed also whispers in other ways. It pushes you to over-leverage, to increase lot sizes after a few wins, to risk your account on a single perfect setup. Greed doesn't care about probability or process. It only craves more, and in doing so it destroys consistency. Then comes impatience. This is perhaps the most underestimated enemy. The market often spends hours moving sideways, building setups slowly, testing your ability to wait. But most traders can't handle the silence. They need action. They need the rush of pressing the button. So they invent opportunities that aren't really there. They take mediocre trades just to feel busy, and those poor quality decisions usually lead to losses. Worse, impatience creates a vicious cycle. After losing on a bad setup, the trader hesitates when the real opportunity finally appears. By the time they gather the courage, the move is gone. Impatience punishes you twice, once when you lose on a fake setup, and again when you miss the real one. On the opposite side of fear and impatience lies overconfidence. This is the most dangerous of all because it blinds you to risk. After a streak of wins, the trader starts believing they can't lose. Rules feel unnecessary. Risk management feels optional. They increase position size, bend their strategy, ignore stop losses. And then, in one single trade, the market humbles them. Weeks of progress vanish in minutes. Overconfidence is seductive because it disguises itself as strength. But in reality, it's just another form of emotional weakness, a refusal to accept that the market is always bigger than you. Together, these four forces form a storm that wipes out discipline. And here's the thing, you can't eliminate them. Fear, greed, impatience, overconfidence, they are part of being human. The goal isn't to kill them, but to manage them. Professional traders still feel fear. They still feel greed. But they've built systems and habits strong enough to keep emotions from taking the wheel. Consistency doesn't mean being emotionless. It means refusing to let emotions dictate your actions. Let's make this concrete with an example. Imagine Sarah, a trader who spent months backtesting a solid system with a 55% win rate and a good risk-to-reward ratio. On paper, it worked beautifully. But when she started trading live, fear and greed tore her apart. After 2 losses, she abandoned setups that fit her rules. After 2 wins, she doubled her lot size and blew her gains. Sarah didn't fail because her system was bad. She failed because she couldn't manage herself. Now contrast Sarah with Michael, another trader using the same system. Michael understood that emotions would come, so he prepared for them. He journaled every trade, writing not just the entry and exit, but what he was feeling at the time. He noticed patterns, like how he always wanted to exit early after a loss, or how he risked too much after a win. Slowly, through awareness and repetition, he built discipline. He didn't fight to eliminate fear or greed. He accepted them, but acted according to plan anyway. Over time, his results stabilized. His system worked not because it was magic, but because he was consistent. This is the reality most traders don't want to face. The battle isn't with the market, it's with yourself. The charts don't care about your hopes, your fears, your need to be right. Every candle is neutral. It's your interpretation that turns it into danger or opportunity. Until you accept this, you'll always sabotage yourself. And here's the hardest truth. These enemies never truly disappear. Fear will whisper when you're in a drawdown. Greed will whisper when you're on a winning streak. Impatience will whisper in the quiet hours of consolidation. Overconfidence will whisper when success makes you arrogant. The voice never stops. The question is, will you listen, or will you stick to your plan? That choice is what separates amateurs from professionals. So ask yourself, how many times have you cut a winner short because of fear? How many times have you blown profits because of greed? How many setups have you missed because impatience made you take the wrong ones? How many times has overconfidence made you feel untouchable right before the market humbled you? If these patterns sound familiar, don't be discouraged. You're not alone. Every trader has faced them. The difference between failure and success isn't whether these emotions exist. It's whether you have the discipline to act in spite of them. Consistency is built the moment you stop letting your emotions make decisions for you. And that's the secret most never discover. If fear, greed, impatience, and overconfidence are the enemies of consistency, then discipline, clarity, and routine are the weapons that defeat them. Consistency is not about finding some secret formula hidden in the markets. It's about building a structure so strong that your emotions can't knock it down. Most traders fail not because they lack strategy, but because they lack systems that protect them from themselves. The first step is clarity. Without clarity, there can be no consistency. Most traders think they have a plan, but in reality their rules are vague. Enter when the market looks strong. What does that mean? Exit when momentum fades. How do you define momentum? These soft rules leave too much room for emotional interpretation. A consistent trader removes ambiguity. They know exactly what conditions must be met before they enter a trade. They know their stop loss, their target, their maximum risk before they even open the platform. Nothing is left to chance. When you lack clarity, you'll find yourself guessing. And when you're guessing, emotions will always win. The second step is trust. Even the clearest system is worthless if you don't trust it. Many traders spend months building a strategy, but the moment they face a losing streak, they abandon it. They dig up the seed before it has time to grow. Imagine a farmer planting crops and then, 2 days later, pulling them out of the ground because he doesn't see results yet. That's exactly what traders do when they give up too soon. Trust comes from testing. If you've back-tested and forward-tested your system, if you know the numbers, the win rate, the average risk to reward, the drawdown periods, then every single trade becomes easier to accept. A loss no longer feels like failure. It feels like part of the story. Trust transforms losses from emotional catastrophes into statistical inevitabilities. The third step is routine. Professionals don't wake up, glance at the charts, and wing it. They follow rituals. They prepare before the market opens. They set intentions. They journal afterward. These routines build mental structure. Without routine, you drift. With routine, you anchor yourself. Think of an athlete. A sprinter doesn't show up at the Olympics without warming up. They follow the same sequence every time because routine calms the nerves and primes the body. Traders are no different. Routine turns chaos into order. This is where journaling becomes one of the most powerful tools a trader can use. A journal is not just about writing numbers down. It's a mirror. It shows you not just what the market did, but what you did. Over time, you begin to see patterns not in price, but in behavior. Maybe you notice that most of your losing trades come when you break your rules. Maybe you see that you always cut trades early after a loss. Maybe you notice that greed pushes you to hold too long. Without a journal, you're blind to your own habits. With one, you become your own coach. And here's the irony. The more you track yourself, the less you repeat your mistakes. The fourth step is patience. Patience is the hardest virtue in trading because everything in our brain is wired for instant gratification. Every win gives us a dopamine rush. We crave more. That's why traders overtrade. That's why they can't sit on their hands. But here's the paradox. The more you chase quick wins, the longer true success takes. And the more you embrace patience, the faster consistency arrives. Think in years, not days. Consistency is not built in a week. It's built slowly, trade by trade, routine by routine. The traders who succeed are not the ones who sprint. They're the ones who endure. The fifth step is detachment. You cannot tie your self-worth to the outcome of a single trade. Too many traders ride emotional roller coasters, feeling like geniuses on winning days and failures on losing ones. This is toxic. It blinds you to the bigger picture. A consistent trader sees themselves as the operator of a process, not a gambler chasing wins. When you win, you log it and move on. When you lose, you log it and move on. You don't collapse or celebrate like a king. You simply follow the plan. Detachment doesn't mean apathy. It means caring about the process, not obsessing over the temporary result. The sixth step is emotional mastery. And let's be clear, mastery doesn't mean eliminating emotions. You can't. Fear, greed, frustration, excitement, they will always exist. Emotional mastery means observing them without obeying them. It means feeling fear, but still taking the trade because your rules say so. It means feeling greed, but still exiting at your target because that's the plan. It means feeling frustration after a loss, but not abandoning your system. Think of emotional mastery as standing in the middle of a storm. The thunder roars, the lightning flashes, but your feet are firmly planted. You hear the chaos, but you don't move. Finally, there is humility. The market is bigger than you, smarter than you, and owes you nothing. The moment you believe you've mastered it, it will humble you. That's why consistent traders never stop learning. They adapt when conditions change. They refine their systems. They respect uncertainty. Humility is what keeps you disciplined because it reminds you that you are not in control of outcomes, only of your actions. Let's bring this together with a story. Picture Daniel, a trader who spent 3 months designing a simple trend-following system. He tested it, trusted the math, and knew his numbers. His first live week was rough. 5 trades, 3 losers, 2 winners. Most beginners would have quit. Daniel didn't. He journaled everything. He noticed his fear kicking in after losses. He noticed the temptation to move stops wider. He wrote it all down, and he stuck to the plan anyway. By the end of the month, he wasn't a millionaire, but he was profitable. And more importantly, he was calm. What separated Daniel from thousands of others wasn't intelligence. It wasn't some secret strategy. It was his ability to stay consistent despite discomfort. This is the essence of professional trading. Not excitement, not adrenaline, not gambling, but routine, discipline, repetition, the boring process that builds long-term results. Most traders fail because they crave excitement. They want every trade to feel like the big one. But real consistency feels almost dull. It feels predictable, not because you can predict the market, but because you can predict your own actions. And that's the shift most traders need to make. From chasing outcomes to executing processes, from needing excitement to embracing boredom, from being ruled by emotion to being guided by discipline. That's how you move from chaos to consistency. Consistency is not a destination. It is not something you arrive at one day and keep forever. It is a practice, a habit, a choice you must make again and again, every single day you sit down at your desk. The moment you think you've mastered it, inconsistency creeps back in. That's why the best traders are humble. They know that discipline is not a trophy you win once. It is a muscle you train daily. Think about it like this. A bodybuilder doesn't grow muscle by lifting a massive weight one time. They grow through repetition, through showing up every day, lifting manageable weights, building slowly over months and years. A musician doesn't master their instrument by playing perfectly once. They master it by practicing scales, making mistakes, learning and repeating. Trading is no different. Your growth is not measured in a single trade or even a single week. It's measured in the thousands of decisions where you choose discipline over emotion. And this is where most traders stumble. They think consistency means winning every day or making money every week. But that's not reality. Even professional traders have losing weeks. Some even have losing months. Consistency doesn't mean perfection. It means sticking to your process through the ups and downs. It means zooming out far enough to see that the equity curve still trends upward. Even if the short term feels messy, the irony is that the very thing traders crave, the thrill, the adrenaline, the excitement, is the exact thing that destroys consistency. If trading feels like gambling, you're not trading, you're chasing dopamine. True consistency feels calm, it feels structured, it feels boring. And that's why so few ever achieve it. Because human beings crave excitement, not repetition. But those who embrace the repetition, the boring process, are the ones who win. Let's make this personal. Imagine 2 traders starting today. Both learn the same strategy. Both practice for the same number of hours. Both face the same market. One treats it like a casino, chasing quick wins, changing strategies every time emotions flare. The other treats it like a craft, following rules, journaling, staying patient. A year later, the first trader is burned out, broke, and frustrated. The second, even if not rich yet, has built something priceless, a foundation of discipline that will carry him forward for life. This is the hidden truth. Consistency compounds. Like interest in a savings account, small, steady actions become massive results over time. One trade executed with discipline may not change your life, but 1,000 trades executed with discipline will. The question is not whether your edge works. The question is whether you will work it long enough to let probabilities play out. And here's another truth most never realize. The battlefield of trading is not on the charts. It's in your mind. Every candle is neutral. Every chart is just data. The market doesn't know you exist. It doesn't care about your feelings. The only enemy that can destroy you is the one inside. The fear that cuts trades early, the greed that pushes risk too high, the impatience that forces bad setups, the overconfidence that blinds you to risk. Conquer that enemy and consistency becomes inevitable, but there's an even deeper layer. Some traders sabotage themselves, not because of technical mistakes, but because of identity. Deep down, they don't truly believe they deserve success. So even when they're profitable, they give it back. They find ways to lose. It's not the market taking from them. It's their own self-image, pulling them back to the level they're comfortable with. Until you change the way you see yourself, consistency will always slip through your fingers. Because consistency is not just about what you do. It's about who you are. So ask yourself, who are you becoming each time you sit down to trade? Are you the gambler chasing excitement? Or the professional executing a process? Are you the person who abandons rules when emotions hit? Or the person who follows through regardless of discomfort? Every decision shapes your identity, and identity is what drives long-term consistency. This is why trading is one of the greatest mirrors of the human spirit. It exposes you. It forces you to face your weaknesses, your fear, your greed, your need for control. And in that struggle lies the greatest reward, not just financial growth, but personal growth. Because if you can master yourself in the chaos of the markets, you can master yourself in life. The choice is yours. You don't need to be perfect. You don't need to predict the market. You don't need to eliminate emotions. You just need to be consistent. That means showing up every day, following your plan, trusting the math, detaching from outcomes, choosing discipline over impulse, over and over again, until it becomes who you are. And if you do that, if you commit to the boring, repetitive process that everyone else avoids, you will find what most traders search for but never attain: consistency, the real holy grail of trading. So the next time you sit down at your desk, remember, the market doesn't demand brilliance from you. It doesn't demand perfection. All it asks is that you follow your plan long enough to let probability work in your favor. The only question is, will you choose consistency today? If you're ready to take this deeper, to train your mind the way professionals do, I created a guide. Master your mind, master your trades. It's filled with practical steps to build discipline, control your emotions, and finally break the cycle of inconsistency. The link is in the description and the pinned comment, because trading isn't about the next win or the next loss. It's about the thousands of trades that shape your future. And your future is not decided by luck or chance. It's decided by the discipline to be consistent when everyone else is not.